Wow, what a packed 24 hours it has been in the market. Seriously, we've seen some huge earnings beats that sent stocks flying, some really shocking misses that made everyone scratch their heads, and a massive deal that could honestly reshape the entire streaming landscape. So let's just dive right in. It was really one of those days packed with big corporate news, and it perfectly highlights the split we're seeing this earnings season. Some companies are just firing on all cylinders, right? While others are hitting some serious roadblocks. So let's start by looking at which companies soared and which ones, well, stumbled. All right, first up, the main event, the absolute flood of corporate earnings reports. This is where we get a real look under the hood of some of the biggest names in retail, tech, and healthcare. Let's see who came out on top. And we had some very clear winners. I mean, Wayfair absolutely crushed it, beating what everyone expected for both revenue and profit, what Wall Street calls the top and bottom lines, and that sent the stock surging. Then you've got Bausch Health, which not only swung back to a profit, but saw its revenue jump 7%. But the real story for Bausch is how they did it. The engine behind that growth was their Solta medical division, which grew a staggering 25%, mostly thanks to massive demand over in the Korean market. Just a brilliant example of a global strategy really paying off. But yeah, it wasn't all good news. Starbucks took a major hit. Their official earnings per share plunged 85%, mainly because of some big restructuring costs. Teladoc also missed, and its key mental health segment, BetterHelp, actually shrank by 8%. But the most fascinating story here has to be CoStar Group. It's a total paradox. Their revenue jumped 20%, which sounds great, but the stock cratered 15%. This is such a stark reminder that in this market, what you say about the future is everything, and weak guidance can signal real concerns about big headwinds, like a slowing commercial real estate market. Now for what might be the most nuanced report of the day, Carvana. This slide just perfectly lays out the split decision from the company. On one hand, you've got this massive revenue beat, pulling in $5.7 billion when the street was only looking for $5.1 billion. But on the other hand, a clear miss on profitability, with earnings per share coming in lower than everyone hoped. So, how is Carvana trying to bridge that gap between selling a ton of cars and actually making more money? Well, they're innovating. They specifically pointed to this new day-of-delivery service they're testing out in Phoenix. It's a big strategic bet on customer convenience, trying to make the car buying process even faster and more seamless. It's definitely a move the market is going to be watching very, very closely. Okay, let's shift gears now from individual earnings reports to the single biggest strategic move of the day. This was a major deal in the streaming wars that sees two giants combining forces to create what could be a new powerhouse in live TV streaming. So let's break this thing down. First, the deal itself. FuboTV has officially merged its business with Disney's Hulu Plus Live TV division. Second, leadership. Fubo's CEO, David Gandler, is staying on to run the newly combined business, which is a key sign of stability. And third, the synergy play. Fubo's ad sales team is going to get absorbed into Disney's massive advertising machine. That's where they expect to create a ton of new value. And this slide right here, it shows you the new power dynamic. Make no mistake, while the Fubo brand and leadership are still around, Disney is firmly in the driver's seat now. They're going to own a controlling 70% stake in the combined company, with Fubo TV's original shareholders holding the remaining 30%. This is a huge consolidation play by Disney. Okay, so now that we've covered the big corporate news, let's see what the pros are saying. What are the analysts thinking, and where are the insiders putting their money, or taking it off the table? Let's kick things off with a company that's still riding high from its strong report earlier this week, SoFi. Their solid earnings beat clearly caught Wall Street's attention, and some of the biggest names out there have been quick to reward them. And we're not just talking about one or two analysts. The heavyweights, like Citi and Goldman Sachs, both came out and raised their price targets. That's the price they believe the stock is going to hit. And that kind of validation, well, it can create some real momentum for a stock. That positive sentiment wasn't just for SoFi either. Warner Bros. Discovery got a double dose of good news, an upgrade to buy from Argus, and a massive price target hike, all the way to $25 from Barrington Research. And the coffee chain Dutch Bros got a nice boost as Mizuho started covering the stock with a really bullish outperform rating. Okay, so before we get to this next slide, we need to understand a little piece of jargon, a Form 4 form. In the simplest terms, it's a heads up.
It's a public filing that insiders or major shareholders have to make when they intend to sell a large block of stock. It's not a sale just yet, but it's a public signal that a big sale is planned.
And that brings us to this number. A major shareholder in the energy drink company Celsius just filed one of those Form 144s, signaling their intent to sell over $135 million worth of stock. This massive potential sale is now officially on the market's radar, and you can be sure investors are watching very, very carefully to see what happens next. So, after a total whirlwind of a day, what's next? Well, the earnings parade is far from over. In fact, you could argue some of the most anticipated reports are still on the horizon. Let's take a quick look at the week ahead.
The action continues immediately, with the entire crypto world watching Coinbase report after the bell today. Then next week is just packed. We're going to hear from the consumer health company Hims and the newly merged Fubo. But the main event is going to be this fintech and insurtech onslaught, with Robinhood, Lemonade, Allstate, and Affirm all stepping up to the plate.
So, what's the big takeaway from all this? It really is a story of divergence. We saw a clear split today. Companies that executed well, like Wayfair, were rewarded, big time. But companies that showed any sign of weakness or gave cautious guidance, like CoStar, were punished severely. And this all just sets the stage for the next wave of reports from some of tech and fintech's biggest and most disruptive names. And that leaves us with the big question as we head into the rest of the week. With a critical report from Coinbase coming in just a few hours, and a full slate of these game-changing companies on deck. Is this earnings season going to be the catalyst that lifts the market higher, or are we about to see its limits truly tested? Thanks for tuning in.